We are 36 hours from a potential financial meltdown that could reshape the global monetary system. China has been quietly accumulating gold at unprecedented levels, officially reporting 2,264 tons, but analysts estimate the true figure is closer to 4,000 to 5,000 tons. At the same time, China has slashed its U.S. Treasury holdings from $1.3 trillion at the peak to approximately $750 billion today, a 42% reduction. This weekend, rumors are swirling of closed-door meetings between BRICS nations discussing a gold-backed trade settlement system. This is the most dangerous 36 hours for the dollar in decades. China holds the nuclear option, simultaneously dumping U.S. treasuries while revealing a gold stockpile that dwarfs official reports and backing the yuan with gold. In the next 13 minutes, I'll show you exactly what's happening, why the next 36 hours are critical, and how to position yourself before Monday's market open. Hit subscribe and turn on notifications. Tomorrow I'm releasing Emergency Portfolio, What to Hold When the Dollar Breaks. Let's go. To understand what's happening, you need to understand China's long-term strategy. For over 2 decades, China has been preparing to challenge dollar dominance. The plan has 3 components: accumulate gold, reduce dollar exposure, and build alternative payment systems. All 3 are now converging. China's official gold reserves stood at 2,264 tons as of late 2025, according to the People's Bank of China. But independent analysts, including those at Goldman Sachs and the World Gold Council, estimate China's true holdings could be 4,000 to 5,000 tons or higher. China buys gold through unofficial channels to avoid moving the market: state-owned banks, military purchases, and Hong Kong imports that don't show up in official reserve data. In 2024 alone, China imported approximately 1,200 tons of gold through Hong Kong, a 40% increase year over year. Shanghai Gold Exchange physical delivery volumes are up 35% year over year, and Chinese gold prices consistently trade at a premium to London spot prices, signaling strong domestic demand. At the same time, China has been systematically reducing its holdings of U.S. Treasury securities. At the peak, China held over $1.3 trillion in U.S. government debt, making it the largest foreign holder. As of late 2025, that figure has fallen to approximately $750 billion. There's a reduction of $550 billion, or 42%. This is not passive portfolio rebalancing, it's strategic de-dollarization. China is also building the infrastructure for a post-dollar world. The mBridge central bank digital currency project connects China, the UAE, Thailand, and Saudi Arabia, allowing cross-border payments without dollars. The yuan is increasingly used for oil purchases, with Saudi Arabia, Russia, and Iran. BRICS is expanding rapidly, with over 40 countries expressing interest in joining or partnering with the bloc. The 36-hour timeline refers to this weekend, a hypothetical window when BRICS or Chinese officials could hold closed-door meetings and make announcements before Monday. It's Asian market open. Rumors have circulated in financial circles about a potential Chinese announcement of unreported gold reserves, possibly combined with a yuan gold backing mechanism or BRICS gold settlement system. If such an announcement happens, Monday morning in Asia will trigger panic selling of the dollar and panic buying of gold. The dollar index, known as DXY, currently sits around 106. Critical technical support is at 100. If DXY breaks below 100 and fails to recover, it signals a breakdown of dollar confidence. Combined with a Chinese gold announcement, the break could be catastrophic, triggering emergency Federal Reserve interventions, Treasury yield spikes, and a flight to gold that sends prices vertical. While retail investors in the West hold dollar-denominated assets, savings accounts, bonds, money market funds, and are told the dollar is safe and backed by the full faith and credit of the United States. China has been quietly exiting dollars and accumulating the one asset that cannot be printed: gold. When the announcement comes, Western retail investors will be caught flat-footed, holding devaluing dollars while Chinese institutions and sovereign wealth funds sit on appreciating gold. Wall Street banks and hedge funds with access to geopolitical intelligence are already positioning. They've been rotating out of long-duration treasuries, buying gold miners, accumulating physical bullion, and hedging dollar exposure. Retail investors, by contrast, are being told by financial advisors to stay invested in 60-40 portfolios with heavy treasury exposure. When the dollar breaks and treasury prices collapse, it's retail that gets wiped out. Meanwhile, mainstream financial media downplays the threat. They dismiss China's gold buying as routine diversification. They ignore the $550 billion reduction in treasury holdings. They mock anyone warning about dollar collapse as a conspiracy theorist. This is psychological warfare. Keep the public calm and invested in the system while the foundation crumbles beneath them. Let's examine the data. According to the People's Bank of China, official gold reserves stood at 2,264 tons as of December 2025. However, China paused reporting monthly gold purchases for several months in 2024, then resumed. During the pause, independent analysts estimated that China continued buying through non-transparent channels. When reporting resumed, the disclosed increases were smaller than market observers expected, suggesting unreported accumulation. Hong Kong gold import data shows China imported approximately 100 tons in 2024, according to Hong Kong Census and Statistics Department data. This represents a roughly 40% increase compared to 2023. Not all of this gold flows into official reserves. Much goes to jewelry, industrial use, and private investment, but a significant portion is believed to be absorbed by state entities. Shanghai Gold Exchange data shows physical gold delivery volumes increased approximately 35% year over year through 2025. The Shanghai gold price consistently trades at a premium of 5 to 15 per ounce above London spot prices, indicating strong demand and limited arbitrage due to capital controls. On the Treasury side, U.S. Treasury International Capital data shows China's holdings of U.S. government securities fell from a peak of over $1.3 trillion in 2013 to approximately $750 billion by mid-2025. The pace of selling accelerated in 2024 and 2025, with China reducing holdings by roughly $100 billion over the past 18 months. The dollar index, which measures the dollar against a basket of major currencies, currently trades around 106. The index peaked above 114 in late 2022 and has been in a gradual downtrend. Technical analysts identify 100 as critical long-term support. A sustained break below 100 would represent a 15-year low and confirm a structural bear market in the dollar. BRICS meetings scheduled for Q1 2026 have fueled speculation about announcements related to a gold-backed trade settlement mechanism. While official agendas are not public, leaked reports from financial intelligence sources suggest gold backing and de-dollarization are top priorities. Gold-backed currency announcements have historically triggered monetary crises. In 1971, when President Nixon ended dollar-gold convertibility, it triggered a decade of dollar devaluation, and gold has risen from 35 to 850 per ounce. In 1999, when European central banks announced the Washington Agreement limiting gold sales, gold bottomed and began a decade-long bull market. More recently, Russia and China have coordinated gold buying while reducing dollar reserves. In 2014, after Western sanctions, Russia accelerated gold purchases and treasury sales. By 2018, Russia had nearly eliminated treasury holdings while doubling gold reserves. The ruble remained volatile, but Russia insulated itself from dollar weaponization. In 2023, when BRICS announced expansion and discussions of a common currency, gold rallied and the dollar weakened temporarily. A full gold backing announcement would be exponentially more significant, a direct challenge to dollar hegemony that could trigger capital flight from dollars into gold and alternative currencies. Signal 1, watch for China. To announce it, holds 1,000 tons or more of unreported gold reserves. If China reveals holdings of 3,500 to 5,000 tons instead of the official 2,264 tons, it confirms years of covert accumulation and signals preparation for WAN gold backing. This would trigger panic buying globally. Signal 2, watch the dollar index. If DXY breaks below 100 and stays below that level for more than 3 trading days, it confirms a breakdown. The next support levels are 95 and then 90. A move to 90 would represent a 15% dollar devaluation and trigger emergency Fed intervention. Signal 3, watch for a BRICS announcement of a gold-backed trade settlement system. If BRICS nations agree to settle oil, commodities, or bilateral trade in a gold-backed digital currency, it represents the end of petrodollar hegemony and a fundamental shift in the global monetary order. Signal 4, watch gold price action. If gold breaks $4,800 and accelerates toward $5,000 within days, it signals institutional panic and confirms that large players are front-running a major announcement. A move to $5,000 would open the door to $6,000 or $7,000 in a meltdown scenario. The fundamentals are undeniable. China has reduced treasury holdings by $550 billion, so a 42% cut from peak levels. China has accumulated at least 2,264 tons of gold officially, with credible estimates suggesting 4,000 to 5,000 tons in reality. Gold imports through Hong Kong hit 1,200 tons in 2024. Shanghai gold trades at persistent premiums. The dollar index sits at 106 with critical support at 100. The U.S. is running $2 trillion deficits with $36 trillion in debt, and the Fed is trapped between cutting rates to avoid recession and defending the dollar. China has every incentive to challenge dollar dominance. Reducing reliance on the dollar insulates China from sanctions, gives it leverage in geopolitical conflicts, and positions the yuan as a reserve currency alternative. Gold is the ultimate reserve asset. It cannot be printed, sanctioned, or confiscated. If China reveals a massive stockpile and backs the yuan with gold, it forces every other central bank to follow. The scramble for gold would send prices vertical. Risk 1, holding dollars and dollar-denominated bonds exposes you to devaluation risk. If China makes a major announcement and the dollar breaks, treasury prices will collapse and dollar purchasing power will fall 10% to 20% within weeks. Risk 2, being underweight gold means missing the biggest safe haven move in decades. If gold goes from $300 to $7,000 in a crisis, that's a 63% gain while everything else crashes. Risk 3, overreacting with leverage or panic selling creates forced errors. Position defensively, but don't use extreme leverage on gold or short positions on the dollar. Volatility will be extreme. Smart play. Hold 20% to 30% portfolio in physical gold and gold miners. Hold short duration treasuries or cash equivalents. Reduce exposure to long duration bonds and dollar-dependent assets. The Federal Reserve and Treasury will tell you the dollar is strong, backed by the U.S. economy, and irreplaceable. They'll say China's gold buying is routine and meaningless. This is psychological warfare to prevent panic. China has cut Treasury holdings by 42%. They're buying 200 tons of gold annually. They're building dollar alternatives. These are not the actions of a country that trusts the dollar. Trust actions, not words. Scenario 1, 45% probability. China announces unreported gold reserves exceeding 1,000 tons. Gold rallies to $5,500 to $6,000. The dollar falls 10% to 15%. Treasury yields spike. The Fed intervenes with emergency measures. This is the controlled crisis scenario. Scenario 2, 35% probability. China dumps treasuries, announces gold reserves, and BRICS reveals a gold-backed settlement system simultaneously. The dollar crashes 20% or more. Gold spikes to $7,000 plus. Global financial markets freeze. Emergency central bank coordination is required. This is the meltdown scenario. Scenario 3, 20% probability, no announcement this weekend. The crisis unfolds slowly over months. Gold grinds to $5,000 by mid-2026. The dollar weakens gradually. No acute panic, just structural decline. Timeline. The next 36 hours through Monday's Asian market open are critical. If announcements come, the crisis accelerates immediately. China holds 2,264 tons officially, likely 4,000 to 5,000 tons in reality. They've cut Treasury holdings from $1.3 trillion to $750 billion, or a 42% reduction. Gold imports hit 1,200 tons in 2024. Shanghai gold trades at premiums. BRICS is meeting to discuss gold-backed systems. The dollar index is at 106, with critical support at 100. We're 36 hours from potential announcements that could trigger a dollar meltdown and send gold to $6,000 or $7,000. Watch 4 signals. China gold announcement, DXY breaks 100, BRICS gold system, gold breaks $4,800. Hold gold. Reduce dollar exposure. Subscribe for tomorrow's emergency portfolio, what to hold when the dollar breaks. Comment? Are you ready for Monday? Let's go.